Thank you very much. It's a pleasure to be here, and it's an honor to be part of the KDI final conference here in Seoul. Let me see. Okay. So this talk is going to, it may not seem on the surface like it's about fiscal sustainability, but it actually is. And it follows up on some remarks that Dr. Kim just made. All of our economies are facing demographic shifts that are going to present enormous policy challenges going forward. And I think that it would be a mistake for us to confront these challenges by thinking only about what fiscal policy needs to do. And instead, I think we need to be thinking about monetary and fiscal policy jointly, and that is going to be the theme of this work. Okay, so if we look at policy institution arrangements around the world, in most advanced economies, we've chosen to maintain a very strict separation between monetary and fiscal policy. So we have the Great Wall of Policy, where on one side of the wall we have monetary policy, and on the other side of the wall we have fiscal policy. And the wall is symbolic because we don't ever want the fiscal side to interfere with the monetary side. So this separation stems from fears that government will end up pressuring the central bank to, run the printing presses and monetize government spending. But it also relies on two highly questionable assumptions. The first is that fiscal policy has little effect on inflation determination. And the second is that impacts of monetary policy on fiscal choices are small. Now, the first assumption is just wrong. Fiscal policy is at least an equal partner with monetary policy in determining inflation. And this has been a key insight of the literature on monetary and fiscal policy interactions. The second assumption, that the impacts of monetary policy on fiscal choices are small, ignores the effects of changes in the price level and bond prices on the value of nominal debt. And this is both a theoretically and an empirically significant point. So George Hall and Tom Sargent have a nice sort of accounting paper that was in the American Economic Journal Macro, where they try to look, they calculate what the source of fiscal financing has been in the United States in the post-World War II period. And during the high debt period, 30 years after World War II, debt GDP fell dramatically. And of that 80.3% drop in the debt GDP ratio, about 16% was due to negative real returns generated by inflation. And this hit primarily long-term bondholders. During the low debt period in the United States, so that's the period from the middle of the 70s to the beginning of the 80s, there were very small fluctuations in the debt GDP ratio, but again, long-term bondholders got negative returns due to unanticipated inflation. But because the level of debt was small and the maturity structure was rather short, the magnitudes here are relatively small. Then we had what we would call the moderate debt GDP level period, which went from the beginning of the 80s, the Ronald Reagan era, until Bill Clinton did the major fiscal reforms in the 90s. And here debt GDP rose from about 20% to nearly 50%. And here the real returns, this is the opposite case, were high due to surprisingly low inflation. Speaking of graduate school, this is the time that I was in graduate school, and I was, very wisely thinking that, inflation's not going to come down. I think what I'll do is take on a big student loan. And so I ended up with a 7% interest rate, and then inflation fell. And thankfully, my wife has gotten me out of debt since then. But that was my first experience in trying to be an economic forecaster, and my last. Okay. Another piece of evidence about this, the importance of this inflation in fiscal sustainability, comes from a picture by Chris Sims. This is in a paper that's in the AER this year, and I highly recommend this paper to people. But what he has done is he's calculated the surprise capital gains and losses to holders of U.S. government bonds. And what you see here is that as a share of GDP, the surprise capital gains and losses are about the same order of magnitude as deficits. So this is non-trivial. These are important changes in the real value of government debt that is generated by surprise changes in inflation. And then the other point I just wanted to make was to just look at what the average maturity of a select group of countries has been, debt maturity. You can see that Korea went from having relatively short maturity to roughly 5-year maturity, along with the US. Other European countries tend to have somewhat longer maturities, with the UK being the outlier with relatively long government maturity. But I want you to think that from this picture, for the points that we want to make, you don't need to have extremely long average maturity. 5 years maturity on average will deliver the kinds of results that I'm going to talk about. So they're plausible. Okay, so there's this consensus assignment that has been arrived at based on research about what policy authorities, what tasks the policy authorities should pursue. And the conclusion of this research has been that monetary policy should be given the job of controlling inflation and aggregate demand, and fiscal policy should be given the job of stabilizing debt. And several optimal policy studies have found that in order to maximize welfare, it's best to adopt what is called an active monetary policy, meaning you basically follow the Taylor principle, you aggressively aim to target inflation, and a passive fiscal policy, which means whenever debt rises, you eventually raise taxes to ensure sustainability. And so what our countries have done is we've made our central banks independent, and we've given them the job of targeting inflation. But then the government has to be given the task of adjusting taxes and spending to ensure that government is solvent. Now, in this consensus assignment, there is no role for revaluations of debt via inflation. And so the consensus assignment actually conflicts with the evidence that I just presented from Hall and Sargent and from Chris Sims. Now, I would argue that this assignment, maybe it was feasible at one time, but I think it's going to become increasingly infeasible. And the last 5 years have really turned this assignment on its head. So monetary policy in many countries hit the zero lower bound, or at least the effective zero lower bound. Central banks then turn to unconventional asset purchases that actually look a whole lot like fiscal policy. Central bank balance sheets exploded and became much riskier, and this endangered their independence. And at the same time, fiscal policy was aggressively trying to stimulate economies in 2008, 2009. Then it became very contractionary, and now who knows what it's doing. But one thing that we've learned from the last 5 years is that it's actually very hard for fiscal policy to change direction. Once it's been stimulative, it's very hard to put the brakes on. And then, as Dr. Kim mentioned, all of our countries are facing these long-run difficulties, and it's going to be extremely hard to pursue passive fiscal policies in coming decades. We have aging populations. We have a lot of unfunded liabilities. They vary from country to country, exactly what the nature of them is, but we all face them. And the other reality we all face is that old people vote. They have a very high propensity to vote. And so the question is, will the older people vote to cut their benefits? And so there's a political economy question that also needs to be confronted. So my own view is that there's very little reason to see a return to this consensus assignment. Now, Cochrane, Sims, and Woodford have actually argued that when you have nominal government debt, then adjustments in current and future price levels can revalue debt and therefore absorb fiscal disturbances. And that was what the picture of the capital gains and losses was all about. But even more importantly, these adjustments can be part of an optimal policy. And the reason is because what these adjustments do is they convert nominal debt into state contingent real debt. And that permits less reliance on distorting taxes. And when you have long debt, this inflation can get smoothed over time, over the term of the debt. So what do we do? Well, we take a very conventional New Keynesian model, sometimes called the Calvo-Yoon model. We have a distorting tax on labor, and then we have a particular way of putting a maturity structure for government debt in. And then we compute the optimal monetary and fiscal policy mix. So finding number one is there's always a role for current and future inflation surprises to revalue debt. Remember, this is the optimal policy. Number two, the role of inflation in optimal fiscal financing increases with the maturity of the debt that's outstanding. Three, inflation is relatively more important as a fiscal cushion in high debt than in low debt economies. And four, we took this model, we calibrated it as best we could to US data. And what we found is that welfare is higher under the fully optimal monetary and fiscal policy than it is under the conventional optimal monetary policy with passively adjusting lump sum taxes. And so I'll get back to that. So those are the findings. So what is the nature of this model? Well, there are several departures from optimality in the model. There are nominal rigidities that create price dispersion. We have taxes that distort, and the steady state is inefficient. And then on top of that, we have some exogenous disturbances that are hitting the economy to technology and fiscal policy. What the optimal policy tries to do is offset this stuff in order to achieve the efficient allocation. So what we do is we follow the work of Benigno and Woodford, which uses a linear quadratic framework with a distorted steady state. And we look at a solution with full commitment, and we adopt this timeless perspective that Woodford has created. So now what you can show is that in this model, there is a micro-founded loss function that is quadratic, and it depends on the square of inflation and the square of the output gap, where the parameters here, the Q parameters, are functions of the deep parameters of the model, so preferences, technology, and so forth. So now what policy is going to do is it's going to choose paths for the nominal interest rate, the short-term nominal rate, and for the tax rate that maximize this welfare function. And they're going to take as given that there's going to be productivity shocks, there's going to be government purchases, and there are also going to be government transfers. So the purchases and the transfers have to be financed in some optimal way. Now these underlying exogenous shocks create three composite shocks that I'm going to show you, the U, V, and F. And those of you who are familiar with this New Keynesian model will see what I mean by U and V in a minute. And then the average maturity of government debt is going to get indexed by this parameter rho. Okay, so two constraints that you're going to face are going to be a Phillips curve, which you can think of as an aggregate supply curve, and then this consumption-Euler equation, which is it's sort of like an aggregate demand curve. So what I've done here is I've just rewritten these are composite shocks, the U and the V. And those things are linear functions of the underlying exogenous disturbances, okay? And all I've done is I've rewritten these things so that you have this tax gap and this interest rate gap. Now, if these were the only constraints that the government faced, then it would be possible to achieve bliss, right? Bliss is defined as absolutely no fluctuations in inflation or output. And you could achieve bliss by just setting the tax rate equal to this tau star and the interest rate equal to this I star. And that would allow you to hit both targets exactly. Now, the thing is that in order to achieve bliss, you have to have non-distorting taxes that can adjust to ensure government solvency. And so I just want to really emphasize this point, that when we think about the Great Wall and we have monetary policy on one side and fiscal policy on the other, implicitly we are assuming that there are non-distorting sources of revenue that can ensure government solvency. Okay? That's implicit. So we're sort of pretending that we live in that world. Now, here's a dose of realism. First of all, we're going to assume that only distorting taxes are available. Okay? Now, you do have to finance non-distorting, say, transfers, but you're not allowed to use those to clear the government budget. This is then going to make government solvency binding, the condition for government solvency, and it creates a trade-off between output and inflation stabilization. And the maturity structure of the debt affects this trade-off. So now we take that same setup and we have to add the third constraint, which is government solvency. And this embeds the term structure. Now this looks really ugly and complicated, and you don't have to worry about it too much. We'll come back to it in a minute. But this F prime summarizes the exogenous fiscal stress. So that includes, this is all exogenous shocks, right? So you've got shocks that are hitting the economy, say through technology, that affects what tax revenues are going to be. You have the government has made all these promised transfer payments to people, that enters this F prime. You also have government purchases, that enters F prime as well, okay? So that's the stuff that has to be financed, and that's the stuff that prevents the government from achieving bliss in this world, okay? Now, what you can do is you can solve for these tax gaps and the interest rate gap from the first two equations up here and substitute them in. So this messy thing completely summarizes what the trade-offs are. Okay, and what you see here is on the left-hand side, this is the stuff that has to be financed, right? So this is the debt that you go into the period with, and this is this fiscal stress. So this stuff has to get financed somehow. And the ways that they can get financed are summarized by, well, you can have surprise inflation today, you can raise current or future tax revenues, or you can have future inflation, which is basically changes in bond prices. Okay? So those are the ways that you can finance things. Now, what do long bonds do? Well, first, they improve the trade-off between inflation and output. So mechanically, what you see here is that what long bonds are doing, that's coming from this rho term, is that the larger is rho, the longer is the maturity, the less fiscal stress there's going to be, because it reduces the demand side shocks. A second thing is it permits inflation smoothing. Again, here, the longer the maturity, the more you can use inflation in the future to offset the fiscal stress. Okay? So that's operating through changes in bond prices that revalue debt. It's exactly that picture of Sims, capital gains and losses for bondholders. The other thing that this does is it provides expected future monetary policy a role in relaxing the government solvency condition. So you can see here immediately, no more Great Wall, okay? We are not rigidly separating monetary and fiscal policy because you have monetary policy playing a role in solvency. And then the third thing that long bonds do is they permit output smoothing. The longer the maturity, again, the more you allow distant future output gaps to offset fiscal stress. Okay, so now there's this beautiful symmetry that comes out of this model. Now, you know, economists are pretty geeky people, and so when they see something like this, they think it's beautiful. What can I say? You know, in any case, if you have only one period debt, then what the optimal policy is going to do is it'll make it perfectly smooths the price level. So it makes expected inflation always equal to zero. And what that means is when a shock hits, you'll get a jump in inflation today, and then it goes right back to zero. Okay? And there's a type of output gap smoothing here, but it's not the same kind of smoothing, and you'll see this in a minute. What this says is that you can't have any expected changes in output after period t+1. On the other hand, if you have only consols, so these are perpetuities, they're bonds that never mature, then you get sort of the reverse. This is what I mean by the symmetry. Now you get a random walk for output, so you're smoothing the output gap as much as possible if you have all long bonds, and you have no expected changes in inflation after t+1. So these are the two limiting cases. You have all one period debt, and you have all perpetuities that never mature. And then if you go the intermediate maturities, it generalizes in a kind of natural way. Okay, so what we do then is we calibrate this model to US data, and I'm just going to show you this picture and then zip through it. So this is what happens if you get an increase in government transfers, a serially correlated increase in government transfers. This is the optimal financing of it, okay, in terms of inflation. If you have all one period debt, then what it's optimal to do is just have a big jump in inflation and then nothing. Whereas once you have consols, so that's the other extreme, then what you get is a jump in inflation, but then inflation is permanently a little bit higher. But you know, infinity is a big number, right? So a little bit more inflation forever does a lot of financing. And that's what's going to help you not have to rely on the distorting taxes as much. And then in the intermediate case, say you have 5-year maturity. I picked 5 because that's relevant to what we actually see. You get a very persistent increase in inflation. So it does go back eventually to zero. But the point is that from the perspective of a central banker, it is optimal to have very persistent deviations from your inflation target. That's what the message of this picture is. Okay, now I'm going to skip that and talk about the fiscal cushion. This will be the last thing I think I can talk about. Okay, what do we have here? Again, this looks kind of messy, but it's not. It just says that the left-hand side is the present value of government expenditures. You have transfers, you have government purchases. What's on the right-hand side? Well, this is the debt you go into the period with. And then you have current inflation. Well, surprise changes in current inflation will be a source of financing. You have the present value of all future inflation. That's coming through bond prices. So that's another source of fiscal financing. And then you have the present value of tax revenues, and then the present value of real interest rates. Now this might seem kind of weird, but it's not weird if you think about it for a minute. What is a present value? Well, it's going to be surpluses discounted, right, by some real discount rate. And when you linearize, that thing shows up as the present value of interest rates, okay? So the right-hand side is just different sources of fiscal financing, and the left-hand side is what has to be financed. So the fiscal cushion is the use of inflation financing as opposed to tax financing. Okay. And if you look at the red lines here, the red lines are calibrated to a debt GDP ratio that's like what's in the US, 50%. And what you see here is this down here is the average duration of debt. So this is in quarters. So this is where 5-year debt is. And what you see is that current inflation doesn't play a really big role. This is the percentage of the financing due to these different sources. It's mostly, if you look at the red line, it's mostly financed by tax revenue. Okay? About 95% or so. But as the level of debt gets higher, so SB is the debt GDP ratio, at 100% debt GDP ratio, you start to rely more on inflation. And future inflation starts to play a much bigger role, especially as debt maturity increases. So again, I want to emphasize that this is part of the optimal financing. This is an optimal policy. And when we start to think about how are we going to confront our aging populations, what theory tells you is you probably don't want to have this complete separation between monetary and fiscal policy. You actually want some interaction between them. And you want to have inflation play some role in stabilizing government debt. And how big a role is going to depend on how much debt the economy has, and it's going to depend on what the average maturity structure of that debt is. So let me just wrap up with these provocative conclusions. So theory does not support this great wall separation of monetary and fiscal policy tasks. Optimal policy argues that there's a role for inflation to revalue debt and to reduce reliance on distorting taxes. And I want to emphasize that this is even in conventional models that are used to justify this complete separation. Optimal policy can entail very persistent deviations of inflation from target. So again, I think about this when I talk to the Swedish Central Bank. So they say things like, normally we try to return to target within 2 years. And I say to them, why do you say that? That can't possibly be true. You know, if you're way far away from target, it's got to be optimal to get back, to take longer to get back, right? And then it might even depend on what the shock is. Some shocks you might get to go back really fast, and some shocks you might go back really slowly. Well, the message here is that if you're part of an optimal monetary and fiscal arrangement, then you can have these very persistent deviations of inflation from target. You don't want to be making, central banks don't want to be making statements like, we normally go back in 2 years, because that's not optimal. And then this other point here that I skipped over is that welfare is higher under these fully optimal policies than under the Great Wall policies. Now that may or may not be a general result. It's going to depend on the calibration and so forth, but in the calibration that we looked at, that was true. And I think the message there is that the fiscal theory outcomes that a lot of people think are really bad things are part of an optimal policy. They're not necessarily bad. They could be bad, but they're not necessarily bad. So this calls, I think, for rethinking about how we've made our policy institution arrangements. And again, as I said in the beginning, it's particularly important in the face of the looming fiscal stress that our economies are facing. So my last slide is that we should, instead of having the Great Wall,
Thank you, Eric, for excellent presentation. I'd like to take a few questions from the floor before you.
Behind you is a question.
My name is Hamna at KDI. I have two questions. First, I spent 2 years at World Bank from year 2011, and you presented a paper, Monetary Science and Fiscal Alchemy. My first question is, you want to break the wall between monetary policy and fiscal policy. Do you want to mix science with alchemy? It's my first question. Second question, according to your presentation, can I expect that you would recommend postponing ending quantitative easing?
Well, regarding the first question, everything I did in here would qualify as science. So this is really monetary and fiscal science. So I'm not advocating that we adopt alchemy. I think that what I was trying to argue was that as we go forward and as we see what's happened during this last 5 years, what we've seen on the fiscal side is a whole lot of alchemy. There's, institutionally, we haven't really maintained this separation anyway. So we might as well try to do it right. Postponing more quantitative easing, I'm not sure that I have anything to say about that. This doesn't really speak to that question. So I would prefer not to take a position on that.
Dr. Gang?
You raised very challenging issues to the central bankers.
I thought you might notice that.
Who are inclined to see their monetary policies independent of the fiscal policies in some of them on the policy makers. And when you raise a question, when you criticize the Swiss bank, the policies of the stabilizing inflation over horizon of 3 years, not regardless of these shocks, the type of shocks. I think one of the reasons that most central bankers that adopting inflation targeting policies, in my view, is one of the communication channels that they use to anchor in inflation expectation of general public. If they had to say that inflation will converge to the target over, say, 5 years, 10 years, or infinite time period, then the central bankers may have problems in communicating their policy, the intent, and anchoring public's inflation expectation toward the inflation target that central banks try to persuade the general public.
Yeah, I know. I've heard that argument. That is exactly, in fact, what the Swedish central bank says to me. And my response to that is, it's not credible to tell people you're going to do something that you're not going to do. And so, if in fact you don't go back to target within 2 years under all circumstances, then it's not credible to tell people that that's what you're going to do. So that's my only reaction is that central banks, if you genuinely are going to go back within 2 years, no matter what, then it's perfectly fine to say you're going to go back within 2 years. It may not be optimal, but you know, that's okay. The problem is that they don't actually go back within 2 years. They just say they're going to go back within 2 years. And so that undermines the credibility.
So, for example, the Bank of England, which also adopted interest tightening, their inflation rate in Britain actually is exceeding the inflation tightening target of 2% over 3 years. So presumably they try to explain that in the extraordinary cases such as global financial crisis, they could extend this 2-year time horizon. So your argument of the depending on the types of shocks, the central bankers may extend the time horizon over, say, 2 years. It may be more plausible for them to use as their communication channel.
Yeah, and from the perspective of communication, the public can understand that, right? The public knows that we have just gone through a major financial shock. And it doesn't take any special communication skills to say that to the people. And so they understand that monetary policy is doing all kinds of unusual things. And the fact that you may then stay away from target for an extended period of time might seem perfectly natural to people. So people do understand contingencies, right? We have contingencies in our daily lives. But central bankers sometimes feel that to communicate clearly, you can't involve contingencies.
Professor? Yeah.
As you know, one important dimension as to the optimal monetary policy these days is how to incorporate financial stability into the monetary policy setting.
I'm sorry, but incorporate what?
Financial stability
Oh,
concern, yeah. And in reality, also, fiscal policy seems to be very much influenced by this financial stability. So, in your model, how would you incorporate financial stability in designing optimal policy mix between monetary policy and fiscal policy?
Yeah, that's a great question. And in fact, my job right now for the Swedish Central Bank is to answer exactly that question. I wish I had an answer. What I think we are grappling for here is a theory that brings together monetary policy, fiscal policy, and financial stability. Those three dimensions, I think, are intimately interrelated. We haven't yet developed that theory. And so, of course, this optimal policy that I'm doing doesn't take account of financial stability considerations. But I think that is exactly what we need. Every country in the world is worrying about these same issues, and they're not necessarily thinking about bringing fiscal policy into the picture, but I think it is natural, especially when you think about financial stability issues and lender of last resort functions and so forth. Those have to involve a fiscal authority. The central bank is not the only player in that game. So I don't have a good answer for you at this point, but I'm working on developing some theory with some people who that's designed to try to address exactly that question.
Okay, one more question. This final.
I have a question about your definition of the Great War policy, because a little technical, but if you think the primary approach, then I think that in the case of primary approach, the Great War policy means the just house of the budget constraint. But if you look at the fiscal, the non-recurrent fiscal policy regime, you might want to add one more constraint. Because so then, under the Great War policy, constraint is 1. Under the non-recurrent fiscal policy regime, constraint should be 2. In very simple, the framework. So then why you have just clarification. You might need definition. More clarification about the definition of the Great War policy, because your welfare is higher under the
Yeah, the idea of the Great Wall was to describe how we have made our policy arrangements, as opposed to what the true structure of the economy is. I agree with you completely that whether we want to treat them as having an integrated budget constraint or separate budget constraints is an important question. But I was speaking not so much about the structure of the economy as I was about the nature of our policy arrangements.